A renewed U.S.-Iran geopolitical shock has sent oil prices soaring and rattled global stock markets. With traders on edge, the question remains, how will this impact your investments moving forward? Looking ahead, investors will closely monitor several factors to assess the duration and impact of this geopolitical shock. Recent escalations between the U.S. and Iran have heightened tensions in an already volatile region, leading to significant fluctuations in global markets. Key indicators such as oil prices, bond yields, and any further military developments will play a pivotal role in shaping investor sentiment. Historically, geopolitical tensions have led to spikes in oil prices due to supply concerns, which can exacerbate inflationary pressures. If oil prices remain elevated, sectors like energy and defensive stocks may outperform growth-oriented equities as investors seek safer havens amid rising costs. Conversely, if diplomatic efforts gain traction and tensions ease, the market could see a swift recovery, potentially reversing the recent sell-off that has rattled many portfolios. The ramifications of these developments extend beyond immediate market reactions. Investors are increasingly concerned about the broader economic implications of sustained geopolitical instability, particularly with inflation already at elevated levels in many economies. Experts suggest that the next few days will be crucial in determining whether this is a mere blip in the market or the onset of a more significant inflation impulse that could reshape fiscal policies worldwide. Analysts are closely watching central bank responses, as any shift in monetary policy could further influence market dynamics. As we navigate these uncertain waters, one question looms large. How will you position your investments in light of this renewed geopolitical risk? With the potential for both market volatility and opportunities on the horizon, strategic asset allocation will be essential. Investors should consider diversifying their portfolios to hedge against potential shocks while remaining agile enough to capitalize on emerging trends as the situation unfolds. The recent escalation in U.S.-Iran tensions did not occur in isolation. For months, geopolitical relations have been strained, particularly after the U.S. withdrew from the Joint Comprehensive Plan of Action, a critical nuclear agreement designed to curb Iran's nuclear ambitions. This withdrawal set the stage for increased hostilities as Iran began to resume its nuclear activities, raising alarms in Washington and among U.S. allies. In the weeks leading up to today, military posturing from both nations had been on the rise, with Iran conducting missile tests and the U.S. deploying additional troops to the region. Yet markets remained cautiously optimistic, with investors hoping for a diplomatic resolution. However, the tipping point came when the U.S. military launched airstrikes on July 25th, signaling a clear departure from diplomatic resolutions. President Trump's declaration that a memorandum of understanding aimed at reducing tensions was no longer valid only added fuel to the fire. This sequence of events underscores the fragility of international relations and the potential for rapid shifts in investor sentiment. Historically, similar conflicts have led to temporary spikes in oil prices, but often resolved with new agreements. The key players in this scenario, U.S. military leaders and Iranian officials, navigate complex interests that intertwine national security, economic stability, and regional power dynamics. The implications of these tensions are profound, particularly for global oil supply and regional stability, as the Strait of Hormuz remains a critical choke point for oil shipments. Looking ahead, the international community faces an urgent need to facilitate dialogue and negotiations. The potential for further military action looms large, and without proactive measures, the risk of a broader conflict could escalate, jeopardizing not only U.S. and Iranian interests, but also global economic stability. The immediate consequences of the U.S.-Iran conflict escalation are already visible, signaling a critical juncture in global economic dynamics. Higher oil prices are set to pressure profit margins for transportation, consumer goods, and industrial companies, which could lead to a ripple effect throughout the economy. The backdrop of this conflict is rooted in decades of strained relations between the U.S. and Iran, with recent provocations exacerbating an already tense situation. As the U.S. imposes sanctions and Iran responds with military actions, the stability of oil supply from the region is increasingly jeopardized. Analysts estimate that a sustained increase in oil costs could raise inflation expectations, which are critical as they influence Federal Reserve policy. This situation poses a direct challenge to the Fed's dual mandate of promoting maximum employment and stable prices. If inflation fears intensify, interest rates may remain elevated for an extended period, weighing on stock valuations across various sectors. Currently, energy stocks are experiencing a boost, reflecting the immediate market response to rising oil prices. However, this volatility has negatively impacted investor sentiment broadly, particularly in growth sectors like technology. The Nasdaq futures, which are sensitive to interest rate changes, illustrate this shift as they dipped significantly amid the geopolitical uncertainty. The average investor should be concerned because these developments could signal a prolonged period of economic instability, impacting everything from household budgets to retirement portfolios. Moreover, the potential for increased tensions could lead to further disruptions in global trade, affecting not only oil but also other commodities and goods. As companies grapple with rising operational costs, consumers may face higher prices at the pump and in stores, squeezing disposable incomes. This economic strain could lead to reduced consumer spending, a key driver of the U.S. economy. Looking ahead, the potential for a prolonged conflict raises questions about the resilience of global markets. Investors may need to recalibrate their strategies in light of persistent geopolitical risks and inflationary pressures. The coming months will be crucial in determining whether the economic fallout from the U.S.-Iran tensions will stabilize or escalate, impacting financial markets and everyday life for millions. On July 26, 2026, fresh U.S. military strikes against Iranian targets ignited a wave of geopolitical anxiety. The strikes, which took place at 10 a.m. local time, were a direct response to escalating tensions fueled by Iran's recent missile tests and aggressive naval maneuvers in the strategically vital Strait of Hormuz. This immediate escalation caused oil prices to rise sharply, with Brent crude increasing by 4% to $95 per barrel, reflecting widespread concerns over potential disruptions in global oil supply routes. As news broke, U.S. stock index futures plummeted, with Nasdaq futures hitting a 4-week low before stabilizing later in the day. Notably, the Dow Jones Industrial Average fell by 300 points before recovering slightly, while the S&P 500 exhibited similar volatility, underscoring the interconnectedness of global markets. This event stands apart from previous conflicts due to the rapid and direct impact it had on market sentiment. Just days prior, investors were trading with optimism, buoyed by strong corporate earnings reports and positive economic indicators. However, this sudden military action jolted investors into uncertainty, amplifying fears of a broader conflict in the Middle East. Analysts suggest that the strikes could provoke further retaliatory measures from Iran, potentially destabilizing the region and prolonging the volatility in global markets. The implications of these developments are profound. Market experts are closely monitoring the situation, as continued military engagement could lead to sustained fluctuations in oil prices and stock markets. Investors may flock to safe haven assets, such as gold or government bonds, as a hedge against rising geopolitical risks. Additionally, if tensions escalate significantly, central banks may need to reevaluate their monetary policies to address inflationary pressures arising from increasing energy costs. As the situation continues to evolve, stakeholders in financial markets and international relations must remain alert. The potential for further military actions could reshape both geopolitical dynamics and economic outlooks in the coming weeks. Observers are particularly focused on how this conflict might influence energy markets and the broader global economy, with implications that could extend well beyond the immediate region. As we consider the potential outcomes of this geopolitical shock, how will you adjust your investment strategy? Share your thoughts in the comments below, and don't forget to subscribe for daily deep dives into the latest news.